By the end of this video, you'll know exactly whether a total stock market fund or an S&P 500 index fund is the better choice and why most people pick the wrong one without realizing it. And here's the thing, the answer isn't the same for everyone, but I'm going to give you a framework that makes the decision crystal clear. So stick around because the last point might completely change how you think about this. Okay, let's start with the S&P 500. Here's why millions of smart investors pick it first. The S&P 500 gives you exposure to 500 of America's largest companies: Apple, Microsoft, Amazon, Google, all the household names all in one fund. It's the most recognized index on the planet, and it has a track record stretching back decades. But here's what most people don't realize. It's not just large cap, it's mega cap heavy. Apple alone makes up about 7% of the entire index. The top 10 companies account for over 30% of the whole thing. So when you buy the S&P 500, you're putting a lot of eggs in a few very large baskets. Now let's talk costs. The most popular S&P 500 fund, Vanguard's VOO, has an expense ratio of just 0.03%, 3 cents per year for every $100 invested. Compare that to the average actively managed fund at 0.82%, and that difference compounds into tens of thousands of dollars over 30 years. All right, so that's point one. The S&P 500 is simple, it's cheap, and it has a strong track record. But here's where it gets more interesting. Now let's look at total stock market funds. These track the entire US stock market, not just the top 500 companies. We're talking about 4000 plus stocks across all market caps: large cap, mid cap, small cap, even micro cap. The most popular version is Vanguard's VTI, and it also has an expense ratio of 0.03%. So cost-wise, they're essentially identical. But here's what you actually own that's different. Everything means you're automatically getting exposure to thousands of smaller companies that the S&P 500 ignores completely, and that matters. Small cap stocks have historically outperformed large cap over long periods. A 2020 AQR paper found a small cap premium of roughly 3% annually going back over 100 years. Nobel laureate Eugene Fama and researcher Kenneth French confirmed similar patterns across decades and global markets. And here's another thing. The S&P 500 has had 3 major drawdowns exceeding 10% in just the last 5 years. COVID, the 2022 bear market, the rate spike sell-off. The VTI weathered all of those same storms, but with less concentration in the mega cap tech names that tend to fall hardest. That concentration creates larger peaks and valleys than most people expect. If you're finding this helpful so far, hit subscribe. I put out investing content like this every week. And stay with me, because the last point is the one most people never hear. Okay, here's the point I've been building toward. The S&P 500 total stock market funds actually overlap significantly. The S&P 500 makes up roughly 80% of the total stock market by weight. So if you hold both thinking you're diversified, you might actually be making your portfolio more complicated without gaining much additional exposure. Here's why this matters for your decision. If you're a long-term investor, 20, 30, maybe 40 years, the total stock market fund has structural advantages. It captures small cap premiums automatically. It has lower concentration risk, and historically, it has slightly outperformed the S&P 500 over multi-decade periods. But here's the one scenario where the S&P 500 might actually be the better pick. If your 401k plan only offers an S&P 500 index fund with a low expense ratio and no total stock market option, then use it. Don't try to force the ideal portfolio when the perfect option isn't available. The difference between VOO and VTI over a lifetime is meaningful but not dramatic. Consistency in contributing matters more than optimizing the last basis point of exposure. So there you go. Both are excellent. Both are cheap. Both will serve you well over decades. But now you know the actual differences: the concentration, the small cap tilt, the structural edge, and you can make the call with real information instead of guessing. If this helped you, share it with someone who's trying to figure out the same thing. And subscribe, because I'm going to keep breaking down investing decisions like this, one clear framework at a time.